Hello, and welcome to the next episode of the Capital Stewards Podcast. You are likely to experience a loss of 30% or more of your investment portfolio in 1 year over the rest of your life. If you're under 40, you're probably going to experience that kind of significant loss more than one time. If you're older, you probably have already experienced it. In the global financial crisis, the S&P 500 fell more than 55% from October of 2007 through March of 2009. 60/40, which was sort of the popular investment mix at the time, fell more than 34% during the onset of the COVID pandemic just a couple of years ago, from mid-February through mid-March. So really a month, the S&P 500 fell more than 33%, and a balanced portfolio then was down 21%. So there are a multitude of risks today: inflation, geopolitics, technology disruption, high valuations, population and immigration changes, and the list goes on. So how do we think about risk as investors? How do we think about these big drawdowns and smaller drawdowns? In this episode, I want to talk about real risk, what it is, how we measure it, and most importantly, what we do about it with our clients. You may have heard a lot of terms associated with investment risk. Terms like max drawdown, volatility, standard deviation, perhaps even value at risk, or some other more complicated statistical concepts. I want to put that off to the side for a moment and reframe risk in a way that I think makes it easier to grasp. Real risk in investing is simply the chance, or perhaps the probability, that you do not accomplish your objectives. If you're saving for retirement, real risk is that you run low on money and you must significantly scale back your lifestyle. That can be really painful. We don't want that to happen. Even if you aren't going to run out of money, you might have other personal goals like building assets for your family or leaving resources to charity. Perhaps you don't accomplish those. That's what real risk is. It's not being able to do things in the real world because our investment portfolios don't perform the way that we expected them to perform. If you're an organization like an endowment or a nonprofit, a risk is that you aren't able to meet your annual spending goals if you have annual spending goals out of your investment account, or that it loses so much value that it ceases to be a long-term asset for your organization and providing that sort of stability that you look for over the long term. So said simply, risk is the chance that you don't accomplish your goals. Standard deviations, other measurement tools, even market corrections aren't really risk. Certainly, there are tools for measuring risk, but they're useful for understanding the real position of your portfolio. But just because the market is up or down over a day or a week or even a year shouldn't actually change the real chances of you accomplishing your goals by much. If you have a well thought out financial and investment plan, market volatility and downturns, even really serious ones, should be accounted for in your plan. We typically run scenarios for clients that include multiple significant recessions and downturns over the course of their investment time horizon. So their plan from day one actually includes several deep recessions, market drops, all the bad things that can happen. Those bad years are sort of baked into the cake, so to speak. So any 1 year or short-term downturn or something like that shouldn't really cause that much disruption to your long-term plan. Again, if your plan was developed and well thought out ahead of time. The single worst investment mistake that you can make is selling out during the market downturns because you can't take it anymore. Then the risk actually becomes reality, and that's what we want to avoid. The stock market in particular moves today based on expectations for the future. That means it's going to move back higher from a bottom before the economy really feels good and makes you want to reinvest your money. Let's look at the financial crisis and COVID as periods that give us really good examples in recent history of this sort of kind of behavior. You can see during the financial crisis, the S&P 500 bottomed on March of 2009 and then was up almost 60% before the end of 2009. So just before the end of the year from the bottom of March, rose 60%. In April of 2009, the Fed was expecting U.S. economic growth to be negative, between negative 1.3 and negative 2%. The economy lost more than 600,000 jobs in March of 2009. GM and Chrysler were not in bankruptcy yet, but they were closing plants and shutting down production lines, all things that don't set up for a significant stock market gain. The news and the feeling was still really negative, but what happened in the remainder of the year was a significant gain in the stock market. If you had started investing in the S&P 500 in January of 2007, you had a couple of challenging years, but your $100,000 turned out to be $299,000 on the chart here by the end of 2019. That's really good, strong gains, right? We saw really strong gains from the COVID period through the end of 2019. However, if you sold out on March 1st of 2009, when the fever pitch was at its worst, when things looked the bleakest, and you didn't get back in until January 1st of 2010, even then things didn't look great. But let's just assume that you said, oh, well, I got to get back in. So I get back in. If you did that, you only have $193,000 in December of 2019. That's a full 1/3 haircut off your wealth. You never make back the money that you lost by not being in there for the initial bounce back from a market bottom. Let's zoom forward a little bit to COVID. The market bottomed in March, down almost 30%, but it recovered to 5% of its previous high by June of 2020. So 1 month down a ton, and then a couple of months to come all the way back almost. If you bought the S&P 500 index with $100,000 again in January of 2020 and you held on, you have almost $200,000 today, almost double your initial investment. Remember, March of 2020 was the first time that most US states saw their first COVID cases. Later that month, that's when they closed schools, issued stay-at-home orders. We started having those daily briefings with President Trump at the White House. That was really the beginning of the pandemic. It was the bottom or the end of the stock market decline. If you sold on March 15th of 2020, when the news was its most dire, and you waited to re-enter the market until the mRNA vaccine was approved, to say, hey, I'll be good as soon as they show that there's some kind of cure for COVID, right? If you just waited till August of 2022, or sorry, August 22nd of 2020 to get back in the market, you have only $158,000 today. So you never overcome the lost time of selling at the bottom because you couldn't handle the decline that happened in your portfolio. So the first takeaway from this episode is to evaluate your portfolio and your financial plan and the real risks that are there. Investment results are never certain. But are you confident that you can accomplish your goals in a variety of market and economic scenarios? And if you're not, now would be a really good time to reevaluate your situation, because you need to be confident that you can hold on if there's a significant decline in the market, if the economy turns out a way that we don't expect. So how do we increase our odds of being able to stick it out and not make the mistake of selling out when things feel really bad because our portfolio is down a lot? That comes from building a portfolio with many different kinds of assets that should reduce the total decline of your portfolio during bad times. I often find that investors think they're diversified because they own more than a few stocks, but their exposure is really just US large cap stocks. They're really well diversified in many US large cap stocks. So one specific company having a problem, isn't going to cause a big issue in their portfolio, but it's really rare that one company in the S&P 500, has like an accounting problem that blows up, right? That doesn't happen often in sort of those, Fortune 500 type companies. But if the whole stock market goes down, then you still have a problem. So ensuring that your stock portfolio itself has more exposure across geographies and company size, like small caps, mid caps, is a good place to start when we think about real diversification. I understand the proverbial argument, right, that returns over the last decade have come largely from US large cap stocks, especially tech stocks. I'm a believer in that trend, right? We've seen that happening. But to meet your investment goals, you can likely afford to shave off a few percentage points of those really, really good US returns to hedge against the risk that we have a decade like the 2000s. So if you look at this, what I call the asset quilt, and this is showing returns over 5 years, you can see that it hasn't been that long since the S&P 500 was not that great. The 2000s, you basically wanted to be anywhere besides the S&P 500 and those sort of large cap US stocks. So we want to diversify holdings internationally by market cap in a well-balanced portfolio, so that if we don't have a repeat of the last 10 years, which every 10 years seems to be a little bit different from an investment standpoint, we still can generate returns to accomplish our goals. Again, the goal is to accomplish our goals, to get the returns that we need to accomplish our objectives, not just to sort of shoot the lights out and hope we make 20 or 30% a year. Once we diversify our stock portfolio, then we need to go beyond stocks. So fixed income or bonds pay interest in exchange for your investment. Instead of having that appreciation of your initial investment, you're earning interest on your money every single month, every single quarter, depending on how it's structured. They can be highly effective when the economy turns sour and interest rates decline. Just like there are many kinds of stocks, there are even more kinds of bonds. The bond market is extremely diverse and very deep. You're probably familiar with treasuries or US government debt. Companies like ExxonMobil, American Airlines, they also issue debt. Banks issue several different kinds of bonds. You can also buy asset-backed bonds that are groups of things like home mortgages, commercial real estate loans, car loans, even credit card debt. Obviously, some of that's more risky, right? But there's a lot of different kinds of debt, from very secure and very safe to more risky that pays a higher interest rate, that you can combine together in a portfolio. Finally, there's private credit or lending to private equity companies. It's been really popular over the last decade or so. We're lending to PE sponsors that are going to go buy businesses. Those loans can have interest rates that are in the low double digits. So the market in the fixed income space is really broad, and different kinds of fixed income can help diversify your portfolio in different kinds of markets. So the types of bonds that you choose to hold depends on, again, what your goals are, what your risk objectives are, what your return objectives are. So it's not the same prescription for everybody, but different kinds of bonds can be really useful as part of a broader portfolio. In our quarterly outlook, we talk about all the different kinds of fixed income, which ones you might consider in the current environment. So I'm not going to go through which ones are more attractive or least attractive kind of here on this particular episode, but you can look at the quarterly outlooks and kind of get a flavor for what we think about all different asset classes, including bonds. So outside of traditional assets like stocks and bonds, that's kind of been the core of a lot of portfolios for the last couple of decades. But you should move beyond that. You should think about owning things like precious metals and commodities. Gold has done really well over the past few years because there's been a lot of uncertainty in the world, uncertainty about inflation, uncertainty about the U.S. economy, changes to buying patterns of global central banks because of geopolitical conflict, right? All of that has driven the price of gold higher. Commodities like oil and gas, corn, even orange juice, almost every agricultural product you can buy futures in. Those can be useful as well, particularly in inflationary environments. Real estate is another great asset class that can diversify your equity market exposure. Some parts of the market, like commercial office, they kind of move with the stock market because they're full of big Fortune 500 companies that are taking up that office space. But there are other parts of the real estate market, timberland, farmland, things like that, that are not as correlated with the stock market. And real estate, you can buy publicly traded funds, privately held funds. You can also just buy individual properties, right? So there's lots of different ways to be involved in real estate. You can even buy shares of public infrastructure like toll bridges, roads, and airports. Those kinds of assets get used regardless of what's happening in the stock market. People still drive, they still go to the airport, even in a recession. Outside of those kind of core asset classes, there's also different types of strategies like hedge funds or long short funds that take some of those assets that I talked about a minute ago, and they combine them in different ways so they can make money in all kinds of different market environments. So they might be long and short, which means they make money when the market goes up in a particular asset and when it goes down in a particular asset. So in addition to the asset classes themselves, there are different types of strategies that you can employ around those assets to enable you to make more consistent returns over the long term. So there are lots of different options for diversifying your investment portfolio to reduce risk and likely to reduce those drawdowns that occur during economic turmoil. So the right assets to own, like I mentioned earlier, and the exact percentages of those assets are unique to each individual or your organization and what your objectives are. So there's not one prescription for everybody. Right now, as I explained in my outlook for 2025, we're in a period of slowing economic growth. Interest rates are high. That's causing the economy to slow down. The economy is decelerating from a period of very fast growth coming off reopening after COVID, right? We also had massive fiscal stimulus that happened at the very end of the Biden administration. And so that sort of, that provided a lot of growth is now fading away. I don't expect a lengthy severe recession, or significantly higher inflation, but both of those things are possible. And so your portfolio should be positioned to manage the risk of either scenario. Gold works really well in the current environment because it should do well in both the uncertainty of a slowdown or a recession, and then it also should do well if inflation unexpectedly picks back up. So you can see there how understanding the economic environment you're in and the available assets then allows you to make smart choices about the right assets to include in a well-balanced, truly diversified portfolio that'll help you manage risk over the long term. So I hope this was a helpful viewpoint on what risk and risk management really are all about. And said simply, real risk is simply the chance that you don't accomplish your goals. And one of the things that will definitely, hurt your chances of accomplishing your goals, right, that will detract from your ability to earn returns over time is if you sell out of your investment portfolio when things don't look great. That is the worst mistake that any investor can make. And so one of the most important risk management strategies is to build a diversified portfolio in a way that, that reduces the volatility, that reduces those max drawdowns, that makes it easier for you to stay in the market over the long term, because that's what's going to give you the best probability of success, the best likelihood that you're going to accomplish all the things that you either personally want to accomplish by investing or that your organization wants to accomplish by investing. So you want to build a portfolio that's really broadly diversified that gives you the best chance to do that over the long term. So if you have questions about risk management or what's going on in the economy today, click the link in the show notes to start a conversation with us. Be happy to continue the conversation with you. And as always, we'll see you on the next episode of the Capital Stewards Podcast.